Londra'dan herkese merhaba. Bu bölümde piyasalara yine özel bir parantez açalım. Pasquale Diana ile buluşuyoruz. Kendisi Finisterre Capital'ın kıdemli makro ekonomisti. Hi Pasquale, thanks for joining our program.
Hi, Berfu. Thank you for inviting me.
Thank you so much. Actually, the first half of this year, 2026, was dominated by war, energy shocks. We talked lots of things. I mean, shifting central bank expectations and etc. As we move on to the second half now, what do you think is the single biggest macro theme investors are underestimating right now?
So it's an interesting starting point. I think in the first half, maybe that's a good place to start. One of the, obviously we had the Iran shock that sort of ran underneath sort of everything else. But then really, I think the biggest surprise to macro practitioners for certain was the resilience of the US economy. Remember, we went into this year expecting the Fed to cut rates and the dollar to weaken. And there's been a significant repricing in that story, both in terms of currency and in terms of yields. We're now, in fact, debating whether the Fed will be forced to raise rates or not this year. And I think that's a segue into the second half of the year. What risks are investors underpricing? I'm not sure if they're underpricing it because the repricing of Fed funds futures has been severe, but we're still pricing two hikes in this cycle. If the Fed really tightens policy because it wants to get in front of the inflation issue, it could easily hike more than twice because obviously, it needs to remove all the accommodation it put in place when they felt the labor market was weakening. Well, guess what? The labor market is not weakening. The labor market is inflecting stronger. And why do we care? But obviously, for emerging market investors and obviously Turkey watchers, this can be a very meaningful development.
hmm So, who would you describe as the winners and losers of the first half?
Well, clearly, I think the U.S. economy emerged as a winner, and with it, the dollar, risky assets also performed well, pushed by tech again. Um, there's concerns about how overextended these capex plans are. I mean, we won't go into details on that today, but I think the issue is, it's interesting that as always in emerging markets, the view is quite nuanced, and I'm sure we come on to Turkey in a minute. But there are countries in emerging markets still with very solid fundamentals, some interesting turnaround stories, and emerging markets tend to do okay or tend to do well when risky assets are bid, and that's why in the second half of the year we will have to see whether these Fed hikes, if they happen in a context of risk appetite which is good or risk appetite which is deteriorating, and that's what's really going to matter.
Yeah. So, could you name a few countries who did well in emerging markets?
Of course. So, two key turnaround stories are obviously Hungary, which had an important election, which put on the table the issue of euro adoption. So, obviously, you have a whole restoration of the relationship with the EU, and then the prospect of the adoption of the euro in a few years' time. Bondholders really like that. Colombia has been a country in clear focus as well, because again, you've had a political event which is perceived to be putting Colombia on a better fiscal footing. So you had bond yields compress in anticipation of this already. You had Argentina perform reasonably well, particularly of late. So all stories which are interesting, sort of turnaround, have performed reasonably well.
hmm what about Turkey? I mean, when you look at, for example, next week, we have this rate decision. Bank of Turkey meets next week. What do you expect from July meeting? Is there room for a rate cut now in Turkey?
It's a good question. I think it's probably going to be a meeting of transition. Let me explain. So if there's a policy rate at 37 and they're funding the market at 40, they could send a signal towards sort of normalizing the funding towards 37, but maintaining conditions as they are. And why would they do that? Because, the June CPI was okay, but maybe they want to wait for another couple of good prints before resuming a more traditional easing cycle. And if we get a couple of good prints, then I think September is a clear chance for them to resume an easing cycle, a more traditional easing cycle. So normalizing funding first, maybe gradually towards the policy rate, and then move to a traditional easing cycle in maybe a couple of months. The constraint, of course, as always with Turkey, will be trying to effectively reward depositors with rates which are high enough so that they stay invested in lira, allowing for a certain pace of depreciation. And so striking the ideal balance in that is, as always, the key challenge and the key constraint.
So you call this as a transition meeting for the normalization of the funding. And you say that, as far as I understand, waiting until September will be a safer option for the rate cuts.
I think so. The traditional rate cuts. So they could send a message in that direction, so markets will understand. But I think markets, especially when you have a scenario where the large central banks are either about to hike rates or talking about rate hikes, I think markets will reward prudence, and I think that's kind of what would make sense to me.
How do you assess the overall macro picture of Turkey?
I mean, look, when the Iran conflict broke out, I think this was one of the places where, we, as analysts, we would worry because obviously it's an oil importer. It's not far from the region. It can be hit by, tourism, missing tourism inflows. It was a fairly heavily positioned story as well. And so it sort of ticked a lot of the I am worried boxes. But then, when we look today, obviously, the Iran situation is far from being solved. I think the way I think about it, at least, is, once again, Turkey seems to have passed the resilience test. We had a drawdown in reserves, and lately they've been rising again. Inflows have come back into the story. The central bank has proven credible. The worst fears about a current account deficit, which would be extremely high, have been at subside somewhat. So we're about sort of 50 billion, 50, 60 billion, depending on your forecast. And we've had, probably, unfortunately, we've had the disinflation story lose sort of waste a few months, if you will. But now, after June and hopefully July, August, again, slowly getting back on track. So I'd say, the worst fears are over. And I think investors, from what I can see, are once again becoming cautiously constructive. The assumption being is that, yes, this is a world where we may see rate hikes from the Federal Reserve, but it's a world where the Fed is hiking for good reasons, i.e. the U.S. economy is strong. And if risk appetite is still bid, as in strong, carry stories like the Turkish lira still have a role to play.
Yeah, you say that the investors are becoming cautiously constructive, you said. So what do we need to see more for long-term bond flows in Turkey?
The disinflation really taking hold. I think my understanding is that because of past performance largely, there's a natural tendency for investors to be skeptical on how long-lasting disinflation is. And I think that's why the majority of investors, at least in fixed income, tend to hide into the carry trade because it's easier, it's more tactical. For them to sort of go into duration buying long-term bonds, I think they need to really see a few prints, not just one or two, of sustained disinflation and a commitment of the authorities to continue the policies that will really entrench disinflation, sort of break the back of inflation. We could be a few months away still, but that would be, I think, a game changer for Turkey Bs because ultimately we know that investors are not heavily positioned at all.
So starting the rate cut cycle will also trigger long-term bond investors to Turkey?
Only if it's seen as credible and as part of. So no, investors will not have any issue with the central bank easing rates if it's seen as a sustainable policy and it's warranted by the trends you see in disinflation. That's exactly what we tend to see in emerging markets. You see good disinflation trend, strong reason for rate cuts. When the central bank does deliver the rate cuts, nothing happens. Actually, maybe more inflows come because it's a good story.
Yeah. Pasquale, Diana, thanks for joining our program.
My pleasure. Thank you.